least in my lifetime, I have never seen rates so low. I mean, as you know, whether it's mortgage rates, whether it's money in a bank, or whatever it might be, you're not getting much. The rate is very low. Now, surprisingly, that's good. It's good for planning, for certain planning techniques. The first of which that is a loan. Okay, is a loan to your child. I'm trying to get on my iPad here. Give me a second here. I have okay, sorry. Not quite as okay. The interest rates for planning purposes, as you probably know, are a product of the applicable federal rate, which is the rate published monthly by the IRS, which governs transactions between related parties, and which is tied, of course, to the economics that exist today. And the imputed interest rate for November is an all-time low. As I indicate in the slide, the short-term federal rate. What is that? That's the rate that you would be required to charge for a loan from 0 to up to 3 years. So the short-term rate is 0.19%. I mean, it's mind-boggling. Okay, the way it works is that you have the short-term, the mid-term, the long-term. The short-term is 0 to 3, and then it's 3 to 9, and then 9 over 9 is the long-term rate. The mid-term and long-term rates aren't much higher. They're just really incredible bargains for planning purposes. Now, the low interest rate environment affects, among other things, the illustration I'm going to have here is the making of a loan, but also affects various time value of money techniques that Jim alluded to earlier. That is the grantor retained annuity trust. It also intentionally defective trust and things of that sort are affected by the low interest rate environment. The example that well, before we get to that, what are the rules? If you have a loan of under $10,000 between related parties, then there is no interest that's assigned to the transaction. Now, what does that mean? Well, it depends on the relationship of the party. In this case, the one we're talking about, related parties, it could be mother to daughter, in which case mother makes a loan of X amount to the daughter. The imputed interest is the amount of interest that the daughter should have to pay for the use of that money. So you have interest that should be paid from daughter to mother, and then you have a deemed gift of the interest amount back to the daughter. So that's essentially how these transactions work. And you can also have the same paradigm in a shareholder corporation situation, or even in an employer-employee situation. All are governed by basically the same rules. Now, loans between related parties, which are less than $100,000, aren't quite as generous. You have to use the applicable federal rate to determine the amount of interest that should be paid by the party, in which case, if mom lends daughter $100,000, well, then daughter has to pay interest on that money as well. Now, the daughter has to pay the interest equal to the applicable federal rate, which we said was, if it were a short-term loan, would be 0.19%. Above $100,000, the rule is that the daughter is required to pay interest or have imputed interest equal to whatever is higher, the applicable federal rate, or any earnings on the funds that are lent. or any earnings that the daughter has or child has. In my example here, just to show you how this works, if a loan is made for $1 million and the applicable rate is 0.19% and it's less than 3 years, the child pays $1,900, and after 3 years the child will pay $5,700 of interest. If the child invests the $1 million in a market investment and gets a 4% return, at the end of 3 years, the child will have $120,000. The net benefit, of course, is $114,000. Now, the child will have tax on it, of course, but I haven't factored in the tax. And by using the low interest, the annual exclusion, if you have two parents, 13.1, whatever the inflation adjustment is for this year, would be 26. And the wealth shift actually increases dramatically. Could be $192,000 if you add it all together, and the parent, of course, gets back their $1 million. So using the low interest environment, you can shift wealth dramatically to the child. Now, the service is not unaware of what's going on, and there is case law, which I don't cite here, but there's case law between trusts and beneficiaries, and the services has taken a position in several cases that the interest shouldn't be any greater than the AFR, and otherwise there's going to be a gift component. So it's not without its potential danger, although the case that generated this result involves a trust in which the child was a beneficiary and the child. So the service said you can't make a loan to yourself, and therefore they imposed sanctions and said that there was the AFR, that it couldn't be any higher than the AFR. In this case, I'm talking about simply making a loan straight out to the child using the current low interest environment.